Palo Alto Networks and Snowflake are two interesting growth stocks that I think many investors are considering adding to their portfolios. But which one is the better growth stock to buy? That's the question I'm going to answer in this video by evaluating Snowflake and Palo Alto Networks across revenue growth, cash flow from operations improvements, and then I'm going to look at valuation measuring by the price to free cash flow and my discounted cash flow valuation models for Snowflake and Palo Alto Networks to determine which one I think is the better growth stock to buy now.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
All right. When looking at price performance over the last year, Snowflake and Palo Alto Networks have not done great. Palo Alto Networks stock is up 7% in the last year, when the broader stock market indices are up much more than that, over 20% in that same time. Meanwhile, Snowflake stock is down 13% in that same time, again, as the broader market is up over 24%. So these are underperforming stocks in the last year, and undoubtedly, that's one of the reasons why investors are curious about these two. Their valuations have improved, their relative valuations have improved, and the markets they operate in are also improving. So let's take a look at revenue growth. So looking at revenue growth, Palo Alto Networks has demonstrated excellent improvement over the last decade at $8.3 billion in revenue. It's the highest pure play cybersecurity revenue generator. If you're bullish on the cybersecurity industry, which I am, I think cybersecurity spending will continue increasing for 2, 3, maybe 4 decades. It's becoming more of a necessity. Regulators are clamping down on companies that don't have sufficient cybersecurity in place. And so spending is increasing, and it's likely to continue increasing. Palo Alto Networks is in an excellent position to benefit from that growth. In recent quarters, well, I should say it's been about a year now, Palo Alto Networks has went for more market share by offering a unique strategy, a unique incentive to cybersecurity buyers. It's telling buyers, look, if you have a 2-year contract with someone else and you join us today, you don't have to pay us for 2 years. So if you have a contract for 2 years, 3 years, 5 years, 1 year, whatever your contract might be with one of our competitors, we'll give you that same amount of time for free with us. And the reason Palo Alto Networks did that is because in its conversations with potential clients, one of the reasons they kept hearing why they're not signing with Palo Alto Networks is because they already have a deal with someone else. And so to counter that, Palo Alto Networks said, fine, we'll give you a free trial so you don't have to pay double for hours and whoever you're paying. It can just be one payment and we'll give you a free trial. You just show us the terms of your contract and we'll give you that free trial. And in that way, Palo Alto Networks is kind of securing customers for the future, so that when instead of waiting for that contract to expire and then going after that customer at that point in time, they're just going after that customer right now and setting themselves up for better growth over the longer term. And that strategy has been working well according to Palo Alto management. So it looks like they will continue, and they've demonstrated increasing billings and contracts as a result of this strategy. Snowflake, meanwhile, of course, it's a data service provider, data marketplace, everything data, and data is the foundation of artificial intelligence. And so Snowflake has been benefiting from those impacts as well. $3.4 billion in trailing 12-month revenue. Management forecasts significant growth well into the 2030s for Snowflake. And one positive in Snowflake's business in recent quarters is that its clients have stopped trying to cut their spending in this category. I remember in late 2022, middle 2023, Snowflake was reporting that its clients were cutting spending. They were looking at their data and saying, look, we have 5 years of data or 10 years of data that we're keeping. Those last 3 years of data, going back 7 years, it's not that relevant. And we're paying so much to store that data, organize that data, clean that data. Wouldn't it be cheaper for us to just eliminate and delete that data? And that's what a lot of companies were doing, according to Snowflake, in late 2022, early middle 2023, when fears of a recession were rising and businesses were looking for areas to cut spending. Thankfully, that's pretty much over with, according to Snowflake management. Businesses are not trying to do that as much anymore. They're focused in different areas. They're not trying to cut costs. They're not afraid of a recession anymore. So that's improved Snowflake's business in recent quarters. So looking at cash flow from operations to sales, they've both demonstrated nice improvement, 25.5% for Snowflake, 39% for Palo Alto Networks. They've both faced some pressure in this category for different reasons. Palo Alto Networks cash flow from operations to sales is down because of what I talked about earlier, right? It's offering free trials. It has to spend money to onboard those customers, and it's not getting money from those customers until their terms are up with the competitors. Snowflake, meanwhile, is spending more money on computing needs, buying more NVIDIA GPUs for its data centers, computing performance. And so that's been bringing down Snowflake's cash flow from operations to sales. Not dramatically, but incrementally, it is down. All right, so now let's look at valuation. Measuring first by the price to free cash flow, Snowflake is about 75% more expensive, according to this metric, at 69, whereas Palo Alto Networks is trading at a price to free cash flow of 40. When I look at my discounted cash flow valuation model for Snowflake, it shows it's also overvalued according to this metric. At my intrinsic value is at $114 a share. The current market price is $165 a share. For Palo Alto Networks, the intrinsic value calculation shows more of a fair valuation. I like to have a margin of safety, and Palo Alto Networks' intrinsic value at $155 compared to the current market price of $174 is within almost my range of margin of safety to call it fairly valued instead of calling it overvalued. So in both cases, when I look at valuation, Palo Alto Networks has the advantage over Snowflake. And given that I'm more optimistic about the duration of growth, not the rate of growth, the duration, meaning how many years I expect Palo Alto Networks to grow compared to how many years I expect Snowflake to grow, if I had to choose between these two growth stocks, I would pick Palo Alto Networks. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.